Hi guys, it's Doc's Market Minute for Thursday, February 11th. This is a daily chart of the S&P 500 futures on a continuous contract basis. And so what we can see this morning, there's about 90 minutes to go before the cash market opens in about an hour and a half or so. So what we've seen is this initial move down in January, straight move down, and then we saw a relief rally basically up to about the 50% fib of that. Almost precisely up to the 50% retracement of this move. All this is done, we talked about this a few days ago actually, all this has done so far is just set up a bear flag. Now this is a very common pattern, and there's two outcomes from this, okay? The first outcome is what we saw back in August to September, is that we showed up with a little flag pattern. Actually, it was kind of large, and then it broke down below there and somewhat retested the low. So depending on which index you're looking at, it either got way far from the low or actually undercut the low slightly. And then, of course, rebounded from there in the month of October in a very strong fashion. So that is what everybody's expecting to see right now, is everybody's expecting to see, and as of this morning, we're down 30, 40 handles and actually slightly undercutting the January lows. So when the cash market opens, if it doesn't recover by that time in the next 90 minutes, we're going to see a lot of opening panic. We're going to see a lot of people washing their positions out and causing that potential capitulation. But what I want to show you is that it may not be over, and what you don't want to do is make the assumption that everybody sees the same things, so therefore we're going to get the same outcome from this. So the expected outcome from something like this, when we come crashing down, get a relief rally, and then kind of roll over and retest, especially with a lower VIX, is that we'll eventually rebound from here and start to build some type of rising wedge pattern. Okay, so we can go back over time and see this time and time and time again, that we see the same type of patterns from this, very similar to this, although I'm not sure that we're necessarily expecting to see a rally quite this strong, but these are extraordinary times. The second outcome that I want to bring to your attention is that a bear flag can be a halfway house in the midst of a much larger swing. And so that's the dangerous outcome that I want to warn you about, which could come, and we'll need to know if that's actually happening. Also, when I was bringing up this chart the other day, I did notice that this now has become a head and shoulders pattern. So we had a much larger head and shoulders pattern. I'll show you that in just a second, in which this is just the right shoulder of that, but now this has become its own head and shoulders pattern by itself. So let's go out to the larger time frames now. Okay, so here's the main SPX cash index, and you can see the larger head and shoulders pattern that's out here. Left shoulder, head, and then we had the right shoulder, which was very truncated, and I'm surprised that we did have one this fast. But you can also see on the chart that I brought up before, the ES chart, the continuous contract, that we had basically a head and shoulders pattern just setting up right over here. Oh, I beg your pardon. That's actually this one right over here, which you can see on the weekly chart. So left shoulder, head pattern, and then right shoulder, okay? So if that is going to work out, then we see what the neckline is from this, and the distance to the downside is basically this distance here from the neckline up to the head. And what we're talking about here is about a 250 point move, and that could actually target somewhere around the 1600 level, which is what I've been talking about for some time. So this 1600 level could come into play. I didn't expect to see this near the end of the year, but it could come into play much sooner than we expect if this actually unfurls. Okay, so let me go back to what I was saying here a minute ago, that if the initial swing here was 269 points in January, 269 points down, and then we bear flagged up for a couple of weeks, and then the new starting point was about 1950, then another 269 points down is going to give us a target which is about 1678 here. So I've got this pink line over here on the monthly chart, and that shows the lower target for this. So my point in bringing this up to you today is not necessarily to scare you or to impress you or anything like that. It's just to say, look, when everybody sees the same thing, then everybody is likely to be wrong, especially in a bear market. And if everybody is just looking for a slight little undercut or a retest of this low and then a bounce from here, if that is the conventional wisdom that that's what's going to happen, then the market usually takes the alternate path of that. When everybody sees the same thing, everybody is wrong. And you also have to ask yourself, when you look at a chart, what move would have to occur to cause the greatest amount of pain to the greatest number of traders? And the answer to that was generally a short squeeze back here through all of this move all the way up here. And now what we have is we have people desperately clinging on to their longs, probably underwater at this point. And so now you have to ask the same question. What move would have to occur in the market to generate the maximum amount of pain? This is also called the principle of maximum adversity. The market will find that point of maximum adversity. And I would suggest that it's going to be somewhere just under the 20% level of the S&P here. And it could be down to the 1678 level, which would mark this bear flag as sort of a halfway house in the move down. So if that is actually what happens, then this is actually playing out to form, because usually what we have is we have a very strong move that clips us at about 20% to kick off the bear market. Now this has already happened in the transports, this has already happened in the Russell, and this is already starting to happen in other indices like the NASDAQ Composite, right? So it too is almost down about 20% right now. And then after we nick the 20%, usually what we have is we have a long grinding wedge type of rally from there. And if you want an example of this, you can look back on the March to June rally in 2008. So that one was about 2-3 months long, kind of a long grinding volatile wedge type of rally. And then what we have is we have the final swing down. And as somebody pointed out in a study recently, is that 60% of the losses in a bear market occur in the last 30% of the time. A typical bear market lasts for about 1.5 years. And so far we've been working on this one since about the summertime of last year. So we've got probably until the end of this year or early 2017 to flush this thing out. And so I would expect to see this type of move. So be cautious about the initial move down, which could show up to 1700 or slightly under that. And from there, we probably have some type of grinding move that's going to occur, in which everybody's going to feel like, okay, this is all over. The worst of it's over. We've already done the bear market thing, and we're going to recover from here, and markets are going to go higher. That's going to be the conventional wisdom probably by sometime this summer. And then the second leg will kick in, which is going to produce 60% of the losses of the bear after that. So keep in mind, right now, this is where all the action is at. Are we just going to get a retest of the lows, and then we're going to recover from there into this kind of grinding rally? Or are we going to use this bear flag as a halfway house, and we're heading down to about 1700? Keep your mind open to either possibility and find a way to make hay during either type of move, regardless of what happens. Frame in the price action and let that be your guide to how you act from here. Hang in there, folks. Thanks for listening. We'll see you tomorrow.